80 Facts About Money and Investing to Help You Fall Asleep. Segment 1, The First 10 Minutes, Where It All Began. Close your eyes and let your mind drift back, not years or decades, but thousands of years, to a world before banks, paper money, or anything we'd recognize as finance. Picture a small village in ancient Mesopotamia. A farmer has harvested more wheat than his family could eat, and a nearby potter has more clay jars than he needs. Neither has a single coin, because coins don't exist yet. But they both have something the other needs. And so they trade. Fact 1. Barter, this simple exchange, is one of the oldest economic activities known to humanity, stretching back at least 9,000 to 10,000 years. Long before writing, long before cities, human beings were swapping goods and labor. It is, in many ways, the original economy. But barter had a problem. What if the farmer needed sandals, but the cobbler didn't need wheat? What if the potter wanted fish, but the fisherman had plenty of pots? Economists call this the double coincidence of wants. Both parties had to want exactly what the other offered, at exactly the same time. As villages grew into towns and towns into civilization, people needed something better. Something that could hold value. Something almost everyone would accept. They needed money, though they didn't have a word for it yet. Fact 2. Among the very first objects to serve as currency were cowrie shells. These small, smooth shells were gathered from the Indian Ocean and Pacific and traveled remarkably far across ancient trade routes. In parts of China, Africa, and South Asia, cowrie shells were used as money for thousands of years, in China, dating back to roughly 1200 BCE. A creature of the ocean, carried inland by human hands, becoming the measure of all things. Different cultures found their own solutions. In much of the ancient world, cattle were wealth. To own a herd was to be prosperous. The word capital, so central to modern finance, traces back to the Latin caput, meaning head, as in a head of cattle. Even today, when we speak of capital, we are quietly still counting cows. Fact 3. Grain served as money in the ancient world, nowhere more systematically than in Egypt. The pharaoh's great grain storehouses functioned almost like banks. Farmers deposited harvests, received receipts, and those receipts could be exchanged for goods and services. It was early deposit banking, thousands of years before anyone built a marble lobby or printed a checkbook. In ancient Mesopotamia, scribes pressed wedge-shaped marks into clay tablets to record debts and obligations. These tablets are among the earliest written records we have of anything, and a striking number are financial in nature. Fact 4. The world's earliest known written records include detailed accounts of loans, interest payments, and commercial transactions. Clay tablets from Sumer, over 5,000 years old, describe loans of silver and grain, complete with borrower, lender, and agreed-upon interest rate. The concept of charging interest is, in other words, almost as old as writing itself. The first things humans felt compelled to write down included, "You owe me, and here is what I expect in return." As trade expanded, new currencies emerged: salt, cloth, tea, dried fish. But one commodity kept rising to the top: metal. Copper, bronze, silver, gold. Metals were durable, divisible, portable, and scarce enough to hold their value. A lump of silver didn't grow on trees, people had to dig for it, smelt it, work for it. Fact 5. For thousands of years, metal was used as money by weight. A merchant wouldn't hand over a coin, he'd hand over a measured piece of metal whose value was determined on a scale. Every significant transaction required weights and a balance. Trust was calibrated in grams. This worked, but it was slow, and required everyone to agree on the metal's purity. A clever trader could mix impure silver with lesser metals and pass it off as real. The world needed a guarantee, a mark of authority that said, "This metal is what we say it is." Around 600 BCE, in a prosperous kingdom on the western coast of what is now Turkey, someone had an extraordinary idea. Fact 6. The kingdom of Lydia is widely credited with minting the world's first standardized coins. These Lydian coins were made from electrum, a natural alloy of gold and silver, and stamped with a lion's head, the symbol of the royal house. Each coin guaranteed a specific, consistent amount of metal. The king's mark was his promise, "You can trust this." The Lydian lion coin changed everything. For the first time, a person could hand over a small stamped piece of metal and complete a transaction in seconds, no weighing, no testing, no negotiating. The coin was the trust. The coin was the promise. The coin was the beginning of the modern economy. Fact 7. The idea spread quickly. Within a century or two, the Greeks, Persians, and Romans had all adopted coinage. In Rome, the mint was housed in the temple of Juno Moneta on the Capitoline Hill. From her name, Moneta, goddess of memory, we get the word mint. And eventually, the word money itself. Fact 8. The word salary, familiar from every paycheck and job offer, comes from the Latin salarium, derived from sal, salt. Roman soldiers were at times paid partly in salt or given an allowance to purchase it. Salt was so essential for preserving food and survival that it carried real economic weight. A man who did his job well was, literally, worth his salt. And so, in the quiet space between then and now, we find the first seeds of everything that followed. The farmer who traded wheat. The shell carried from a distant ocean. The clay tablet pressed with a debt. The gleaming coin stamped with a lion. Money had arrived in the world, not with a crash or a fanfare, but slowly, quietly, the way most great things do. Rest here for a moment. There is so much more still to come. Segment 2, the merchants, the temples, and the Silk Road. When we left our story, a small kingdom called Lydia had just given the world its first standardized coin, a tiny stamped disc of metal carrying the king's promise within it. But a coin, on its own, can only do so much. You can trade it, spend it, lose it. What you cannot easily do is grow it. You cannot put a coin to work while you sleep or lend it to a merchant sailing across the sea and expect to share in his fortune. For money to truly transform civilization, it needed systems. It needed institutions. It needed, in a word, banking. And the surprising thing is just how ancient those institutions really are. Fact 9. Long before any purpose-built bank existed, the first institutions to perform banking functions were temples. In ancient Mesopotamia and Greece, temples were considered the safest places to store valuables, protected not just by walls, but by the gods themselves. Who would dare rob a house of the divine? Priests began accepting deposits of grain and silver, issuing loans, charging interest, and maintaining records with a sophistication a modern banker would recognize. The temple was the vault. The priest was the loan officer. Money and meaning were, from the very beginning, intertwined. As Greek civilization flourished, a new figure emerged in the marketplaces of Athens, Corinth, and Alexandria, the money changer. His table, in Greek, trapeza, was his office and his identity. Fact 10. That word, trapeza, is the origin of the modern Greek word for bank, still used in Greece today. The image of a man sitting at a wooden table weighing coins gave an entire language its word for one of the most powerful institutions in the world. Language, like money, carries the past inside it. These early Greek bankers did more than swap coins. They accepted deposits, made loans, and transferred money between cities using written orders, so a merchant in Athens could arrange funds in Corinth without carrying a single coin through dangerous roads. An early wire transfer, centuries before electricity. Fact 11. The Greeks also pioneered the bottomry loan, a contract in which a lender funded a sea voyage. If the ship arrived safely, the loan was repaid with interest, often 20 to 30%, reflecting the enormous risk of ocean travel. If the ship sank, the borrower owed nothing. The sea absorbed the loss. It was one of history's first examples of risk-sharing in finance, the lender a silent partner betting on favorable winds. Think of that the next time you hear about venture capital. The structure is older than Rome. As Rome rose to dominate the Mediterranean, it brought financial sophistication to match its political ambition. Roman bankers, the Argentarii, operated from fixed locations in the Forum, handling deposits, loans, and currency exchange. Fact 12. At the height of the Roman Empire, a single currency, the denarius, circulated from Britain to Egypt, from Spain to the borders of Persia. A soldier in what is now northern England carried coins minted in Rome. A merchant in Morocco paid with the same currency as a trader in Syria. This monetary unity helped bind tens of millions together, and when the empire fractured, its currency fractured with it, plunging Europe into centuries of financial fragmentation. But even as Rome's star dimmed, the story of money continued, not through crumbling imperial roads, but along a ribbon of routes stretching east, across mountains and deserts and steppes, all the way to China. The Silk Road. Fact 13. The Silk Road was not a single road but a vast network of trade routes connecting China, Central Asia, the Middle East, and eventually Europe. It took its name from the most prized commodity flowing along it, Chinese silk, so luxurious that Roman citizens reportedly paid for it with gold by the weight of the silk itself. At its peak, it carried not just goods but ideas, religions, technologies, and financial practices across thousands of miles. Money, in a very real sense, made the ancient world global. Fact 14. China invented paper money. Tang dynasty merchants, weary of carrying heavy copper coins over long distances, began leaving coins with trusted agents in exchange for written certificates. The Chinese called these feiqian, flying money, because they could travel city to city without the weight of metal. By the Song dynasty, around the 10th century CE, the government was issuing standardized paper currency, the world's first government-backed paper money, circulating in Chinese markets 600 years before the West would embrace the idea. And with paper money came something both revolutionary and dangerous, the possibility of printing more than you had. Fact 15. The Song and Yuan dynasties experienced the world's first recorded paper money inflation. When rulers printed currency to fund wars without gold or silver to support it, prices rose, confidence fell, and the money lost its value. Marco Polo, visiting Kublai Khan's China in the 13th century, marveled that the great Khan could produce wealth simply by stamping paper, but noted the instability that power brought. The lesson was plain: money is a matter of trust, and trust can be broken by printing presses. It is a lesson economies have had to relearn in every century since. Fact 16. Marco Polo's accounts, published around 1300, introduced paper money to European audiences for the first time. Financiers read them with fascination and skepticism. The idea that paper could represent wealth seemed almost alchemical. Europe would take another 3 to 4 centuries to embrace it. But the seed had been planted, carried west along the same routes that brought silk and spice and every other wonder of the East. Each of them, the Greek money changers, the Roman bankers, the Silk Road caravans, the Song dynasty scribes, was asking the same question haunting every economy since that first wheat for pottery trade in ancient Mesopotamia. How do we make strangers trust each other? That question still hasn't stopped being asked. Let your breath slow. Let the markets of the ancient world grow quiet around you. There is more to come, but for now, rest. Segment 3, the Medicis, the merchants, and the birth of modern banking. Let your mind travel now to a different kind of world. Not the sun-baked markets of ancient Mesopotamia, not the marble forums of Rome, not the dusty caravans of the Silk Road, but the narrow, cobbled streets of medieval Europe. Stone cities rising above river bends. Cathedral spires catching the last light of afternoon. It is the Middle Ages. For centuries after the fall of Rome, the sophisticated financial systems of the ancient world have largely gone quiet. The grand unified currency of the empire is gone, replaced by a patchwork of local coins, feudal obligations, and barter. But money, like water, always finds a way. And slowly, in the merchant cities of northern Italy, Florence, Venice, Genoa, something remarkable was beginning to stir. Fact 17. The word bank comes from the Italian banco, meaning bench or table, the same humble piece of furniture Greek money changers had used centuries before. Italian merchants conducted transactions from benches in public marketplaces. When a money changer was found fraudulent or insolvent, authorities would literally break his bench, banco rotto, as public declaration that he was finished. From banco rotto, we get the English word bankrupt. The language of finance is, once again, the language of furniture and public humiliation. The medieval church had complicated feelings about all of this. Catholic teaching held that charging interest, usury, was a sin. To lend at interest was to profit from time itself, and time belonged to God. And yet commerce required credit. Merchants needed loans. Kings needed war financing. Europe's growing economy could not function without money moving between those who had it and those who needed it. Fact 18. To navigate the church's prohibition, medieval bankers developed creative workarounds. The most common was the bill of exchange, a written instrument allowing a merchant to deposit money in one city and receive a different currency in another at a later date. The difference in exchange rates concealed the interest payment inside what looked, on paper, like a simple currency conversion. A financial fiction that kept commerce moving while satisfying the letter, if not the spirit, of church law. Necessity, as always, was the mother of financial invention. It was in this environment that one family rose to shape the entire financial world of Renaissance Europe. The Medicis of Florence. Fact 19. The Medici Bank, founded in 1397, became the most powerful financial institution in 15th century Europe. At its peak, it operated branches in London, Bruges, Geneva, Lyon, Venice, Rome, and beyond, a truly international network at a time when most people never traveled more than 30 miles from home. The Medici Bank handled the finances of popes and kings and accumulated a fortune that underwrote much of the Italian Renaissance. Brunelleschi's dome, Botticelli's paintings, Michelangelo's early sculptures. All of it, in some measure, made possible by Medici money. But the family's greatest contribution wasn't their wealth. It was a structural innovation that changed banking forever. Fact 20. The Medici Bank pioneered the holding company structure, a network of legally separate partnerships, each its own entity but all connected under central oversight. If one branch failed, as the London branch eventually did, after lending enormous sums to the English crown that were never repaid, it could be closed without bringing down the entire network. This separation of risk underpins the corporate world to this day. Every holding company, every subsidiary, every LLC traces a quiet line of descent back to a counting house in 15th-century Florence. Fact 21. The Medici era also gave us double-entry bookkeeping. In 1494, Franciscan friar Luca Pacioli published the first written description of the system, recording every transaction as both a debit in one account and a credit in another. Italian merchants had used it for 2 centuries before Pacioli wrote it down, but his publication spread it across Europe. Every accounting program, every corporate balance sheet, every set of financial statements in the world still runs on the same logic he described. As the Renaissance gave way to the age of exploration, finance faced a new challenge: how do you fund voyages of enormous cost and uncertainty? Individual merchants couldn't afford such gambles alone. Risk needed to be spread across many investors. Fact 22. The solution was the joint stock company. Rather than a single owner funding an entire venture, it raised money by selling shares to many investors, each owning a proportional piece and sharing in gains or losses. The Dutch East India Company, founded in 1602, is widely considered the world's first publicly traded joint stock company, and in issuing tradable shares, it created the world's first stock market in Amsterdam. The age of the modern investor had begun. Fact 23. The Amsterdam Stock Exchange, established alongside the Dutch East India Company, was the world's first formal stock exchange, where buyers and sellers traded shares in businesses they might never visit or fully understand. It introduced concepts fundamental to markets today: continuous trading, price discovery, and a share's value fluctuating with news and collective sentiment. Amsterdam in the early 1600s was the spiritual ancestor of Wall Street. And almost immediately, the new invention produced the world's first great speculative bubble. Fact 24. In the 1630s, the Dutch Republic was gripped by tulip mania. Tulip bulbs, newly arrived from the Ottoman Empire, became objects of intense speculation. At the peak in 1637, a single rare bulb could sell for more than 10 times the annual salary of a skilled craftsman. Contracts for bulbs not yet bloomed were traded on informal markets. Then, almost overnight, prices collapsed. Buyers vanished. Fortunes evaporated. Tulip mania is the first recorded speculative bubble, collective excitement lifting prices beyond any rational value, until the inevitable, devastating correction. It would not be the last time. Not even close. Money is not just metal, or paper, or numbers in a ledger. It is trust made tangible. And when that belief becomes unmoored from reality, the consequences can be swift and merciless. But the story does not end in collapse. It never does. Each crash has always been followed by something new, a new structure, a new institution, a new idea about moving money through the world more safely, more wisely, more fairly. That instinct, to rebuild, to reform, to try again, is perhaps the most human thing about finance. We are making our way, slowly and steadily, toward the world you know. Segment 4, Central Banks, Bubbles, and the Birth of the Modern Monetary World. We left our story in Amsterdam, where the world's first stock market had just been born, and where, almost in the same breath, the world discovered what happens when excitement outpaces reason and a tulip bulb becomes worth more than a house. The lesson of tulip mania, you might think, would have been absorbed quickly. It was not. But before we arrive at the next great catastrophe, and it is a spectacular one, we need to meet an institution that would become perhaps the single most powerful financial force in the modern world. Not a merchant bank or trading company. Something altogether different. Something that would eventually hold the power to shape entire national economies with a single decision made in a quiet, wood-paneled room. A central bank. Fact 25. The Bank of England, founded in 1694, is one of the world's oldest central banks and the model upon which nearly every central bank since has been designed. Its origins were practical and desperate. England had just fought an expensive war against France, the treasury was empty, and the government needed to borrow £1.2 million immediately. A Scottish financier named William Paterson proposed a solution. Private investors would lend the government the money, and in return receive a royal charter to operate a bank, allowed to issue banknotes and conduct business on behalf of the state. The government got its money. The investors got a franchise. And the world got its template for central banking. Fact 26. The Bank of England pioneered the gold standard, the principle that paper currency should be backed by an equivalent reserve of gold in the bank's vaults. Every banknote was, in theory, a claim on a specific quantity of gold, giving paper money a physical anchor. Britain formally adopted the gold standard in 1821, and most major economies followed. It brought extraordinary stability to global trade, and would, more than a century later, be gradually dismantled in one of the most consequential financial decisions of the 20th century. But first, there is a bubble to attend to. And this one makes tulip mania look almost quaint. Fact 27. The South Sea Bubble of 1720 is one of the most dramatic financial collapses in history, greed, political corruption, and mass delusion unfolding in the drawing rooms of Georgian London. The South Sea Company held a monopoly on British trade with South America, which sounded enormously profitable. The problem was that Spain controlled South America and the actual trading rights were extremely limited. None of this dampened enthusiasm. Share prices rose from £100 at the start of 1720 to over £1,000 by summer. Members of Parliament bought shares. The royal court bought shares. Even Sir Isaac Newton bought shares, and reportedly lost the equivalent of several £1,000,000 in today's money. He is said to have remarked that he could calculate the motion of heavenly bodies, but not the madness of people. The collapse ruined thousands and left a scar on British financial culture that lasted generations. Across the Channel, France was having its own catastrophe at almost exactly the same moment. Fact 28. John Law was a Scottish economist, gambler, and convicted murderer who somehow became controller of France's entire economy in the early 18th century. After charming his way into the French regent's confidence, he established a national bank, issued paper currency, and briefly delivered genuine economic growth. Then he attached his bank to the Mississippi Company, which held rights to develop France's Louisiana territory, promoting it as a land of limitless gold and silver. Investors poured in. Prices soared. Then the truth, that Louisiana was, in reality, a mosquito-ridden swamp with no evident treasure, became impossible to ignore. The Mississippi Bubble burst in 1720, almost simultaneously with the South Sea Bubble. Law fled in disgrace, and France remained so deeply suspicious of paper money and banking that it carried the trauma into the French Revolution decades later. The twin disasters of 1720 produced, over time, a growing understanding that financial markets needed rules, transparency, and oversight to serve society rather than periodically devastate it. That understanding was being quietly laid in the coffee houses of London. Fact 29. Lloyd's of London was born in a coffee house. In the 1680s, Edward Lloyd operated a coffee house near the Thames favored by merchants and sailors. Ship owners seeking insurance would post notices on the walls, and wealthy individuals willing to underwrite the risk would sign their names, and the amount they'd cover, below the notice. Those who signed became known as underwriters, a term still used today. Lloyd's eventually formalized into the world's specialist insurance market, still operating 3 centuries later. The word underwriter, a cornerstone of modern finance, was born from the act of signing your name beneath a notice in a coffee shop. Fact 30. The 18th century also saw the birth of national debt as a permanent, manageable feature of government finance. Britain, perpetually at war throughout the 1700s, discovered that by issuing long-term government bonds, paying regular interest to holders, it could borrow vast sums and spread costs across generations. British government bonds, known as gilts after the gilded edges of original certificates, became among the most trusted financial instruments in the world. That trust gave Britain a financial advantage over rivals that arguably mattered as much as the strength of its navy. Fact 31. By the mid-18th century, another new instrument was emerging: life insurance. Early policies were rather morbid, used to wager on the lives of public figures. They eventually became genuine tools for families to protect against the financial consequences of death. The Society for Equitable Assurances, founded in London in 1762, was the world's first mutual life insurance company, introducing premiums calculated on age and life expectancy. It is the mathematical foundation of the modern insurance industry. From the first coins of Lydia to the halls of the Bank of England. From tulip mania to the South Sea bubble. From a Scottish gambler rewriting the French economy to a coffee house that became the world's insurance market. What emerges from all of it, the brilliance and the recklessness, the innovation and the catastrophe, is a portrait of human beings trying, over and over again, to build systems worthy of their ambitions. Sometimes they succeed beautifully. Sometimes they fail spectacularly. And always, always, they try again. Close your eyes a little more. We are nearly home. Segment 5, Steam, Steel, and the Street That Moved the World. There is a particular kind of silence that settles over the world just before something enormous changes it. The silence before the first steam engine hisses to life in a Lancashire mill. Before a locomotive pulls out of a station for the very first time. Before a group of merchants gather under a buttonwood tree on a dirt road in Lower Manhattan and agree, in a few plain sentences, to change the financial history of the world. We have arrived at the late 18th and early 19th centuries. Money, which had spent millennia slowly building its institutions, was about to encounter something that demanded capital on a scale the world had never seen. The Industrial Revolution had begun. Fact 32. The Industrial Revolution, igniting in Britain and spreading across the Atlantic world, required an unprecedented mobilization of capital. Building factories, installing steam machinery, digging canals, and laying thousands of miles of railway track demanded sums so large that no individual could provide them alone. This hunger for capital drove a dramatic expansion of the joint stock company model. Ordinary people, clerks, shopkeepers, farmers, began investing in industrial enterprises for the first time. The democratization of investment was not born on Wall Street in the 20th century. It was born in the smoky cities of industrial Britain, driven by the appetite of the steam engine. Fact 33. On May 17, 1792, 24 stockbrokers and merchants gathered beneath a buttonwood tree on Wall Street and signed a modest two-sentence agreement, the Buttonwood Agreement, establishing rules for trading securities among themselves. They would trade only with each other and charge fixed commissions on every transaction. This simple compact, signed in the open air of a New York street, is the founding document of what would become the New York Stock Exchange, today the largest stock exchange in the world by total value of listed companies. Fact 34. Alexander Hamilton, the first U.S. Secretary of the Treasury, is widely regarded as the architect of the American financial system. In bold reports to Congress between 1790 and 1791, Hamilton proposed that the federal government assume all Revolutionary War debts of individual states and establish a national bank. His opponents, led by Thomas Jefferson, argued a national bank was unconstitutional and dangerously centralized. Hamilton won, narrowly. The first Bank of the United States was chartered in 1791, and the assumption of state debts gave American government bonds instant credibility with European investors. Hamilton's conviction, that a nation's financial strength and political strength were inseparable, has quietly underpinned American economic policy ever since. Fact 35. The railway boom of the 19th century was the largest mobilization of private capital in history up to that point. Britain's railway mania of the 1840s saw hundreds of companies formed and thousands of miles of track proposed, all funded by share offerings sold to an eager, often inexperienced public. At the peak in 1846, Parliament approved over 9,000 miles of new railway lines in a single session. Many companies had little more than a hopeful map and a persuasive prospectus. The crash wiped out countless investors, but left behind a functioning railway network that carried passengers and freight for the next century and a half. Even ruinous financial bubbles sometimes build things that last. Fact 36. The completion of the first transcontinental railroad in 1869 was financed largely through government land grants. The federal government gave railroad companies enormous tracts of land alongside the right-of-way, which the companies sold to settlers to fund construction. In total, over 170 million acres of public land were granted to railroad companies, an area larger than Texas. The line between private enterprise and government subsidy has, in American finance, always been blurrier than the rhetoric suggests. Fact 37. The railroad boom produced the modern investment bank. As railroads consumed capital at unprecedented rates, a new intermediary emerged, raising large sums for corporations by organizing the sale of stocks and bonds to wealthy investors. J.P. Morgan and Company became the most powerful investment bank of the Gilded Age, arranging railroad mergers and organizing the formation of U.S. Steel in 1901, the first billion-dollar corporation in history. J.P. Morgan himself became, in effect, the unofficial central banker of a country that still lacked an official one. Fact 38. That role was never more dramatically demonstrated than during the Panic of 1907. A failed attempt to corner the copper market triggered a cascade of bank runs threatening to collapse the entire American financial system. With no Federal Reserve yet in existence, Morgan, then 70 years old, personally convened late-night meetings in his Manhattan library, summoning the heads of the most powerful banks and reportedly locking the doors until they agreed to a coordinated rescue fund. The crisis was contained. But the episode made clear that a modern economy could not depend on the personal authority of a single private citizen to prevent catastrophe. Fact 39. The Federal Reserve System was established by Congress in 1913. Its creation was itself remarkable. The initial blueprint was drafted in secret in November 1910 at a private gathering on Jekyll Island, Georgia. A small group of the most powerful bankers in the country traveled under assumed names, pretending to be on a duck-hunting trip, and spent 9 days designing the architecture of what would become the most powerful financial institution in the world. The secrecy was deliberate. Public knowledge that Wall Street bankers were designing the central bank would have guaranteed political opposition. The Federal Reserve has, since its founding, set interest rates, provided liquidity in crises, and made decisions that reverberate through every economy on Earth. From the buttonwood tree on a Manhattan street to the locked library of J.P. Morgan. From a Lancashire mill to the secret meetings of Jekyll Island. The financial world is fully modern now. The institutions are in place. The markets are open. What remains is the story of what those institutions did with all that power. For now, let the steam cool and the markets close for the evening. You are doing beautifully. Rest a little more. Segment 6, The Roaring Twenties, the Great Crash, and the New Deal. By the time the Federal Reserve opened its doors in 1914, the modern financial world looked recognizable. Central banks, stock exchanges, government bonds, corporate shares, insurance policies, the architecture was in place. Ordinary families were beginning, tentatively, to participate in markets that had once belonged exclusively to the wealthy. And then the world went to war. The First World War consumed an almost unimaginable quantity of money. Governments on both sides borrowed furiously, printed currency, and suspended the gold standard that had anchored their financial systems for nearly a century. When the guns fell silent, the world's financial architecture was battered and rearranged in ways that would take years to understand. But in America, which emerged as the world's dominant creditor nation, the 1920s brought something else entirely. They brought a party. Fact 40. The 1920s were a decade of extraordinary economic expansion and, in the latter half, extraordinary speculation. For the first time, ordinary American households participated in the stock market on a truly mass scale. Brokerage firms opened in small towns. Newspapers printed stock tables alongside baseball scores. Between 1920 and 1929, the Dow Jones Industrial Average rose nearly 500%. Americans who had never thought of themselves as investors bought shares in automobile companies and radio manufacturers, often with borrowed money, swept along by the conviction that the good times would not end. It was, in the language of every era that follows the same pattern, different this time. It was not different this time. Fact 41. During the boom, a large proportion of stock purchases were made on margin. Investors borrowed most of the purchase price, putting down as little as 10 cents of their own money for every dollar of stock. This leverage magnified gains spectacularly on the way up. But it also meant that a small price decline could wipe out an investor's entire equity, triggering forced selling that pushed prices lower, which triggered more forced selling, a cascade the borrowed money structure made nearly impossible to stop. The margin system had transformed a market correction into a potential catastrophe. All it needed was a spark. The spark arrived in October 1929. Fact 42. On October 24, Black Thursday, panic selling swept through the New York Stock Exchange with such intensity that the ticker tape machines fell hours behind trading. A group of leading bankers attempted a coordinated intervention, publicly buying shares to signal confidence. It worked, briefly. The following Monday and Tuesday brought collapses so severe they eclipsed Black Thursday entirely. By the time the worst was over, the market had lost nearly 90% of its peak value, a destruction of wealth that would not fully recover, in inflation-adjusted terms, until the 1950s. Fact 43. The Great Depression that followed was deepened by the collapse of the banking system. Between 1930 and 1933, approximately 9,000 banks failed, nearly 40% of all banks that had existed at the decade's start. When a bank failed, depositors' savings vanished with it. There was no government guarantee, no deposit insurance, no safety net. Families who had saved carefully for decades lost everything in an afternoon. People buried cash in their backyards. Unemployment reached an estimated 25% at the Depression's peak in 1933, a figure almost impossible to fully absorb. Into this wreckage stepped Franklin Delano Roosevelt, who understood that the financial system needed to be rebuilt from the ground up. Fact 44. One of Roosevelt's most consequential early acts was creating the Federal Deposit Insurance Corporation, the FDIC, in 1933. The FDIC provided a government guarantee on bank deposits up to a certain amount. If your bank failed, the federal government would make you whole. Bank runs largely ceased. People put their money back. The financial system stabilized. The FDIC's core promise remains in force today, nearly a century later, quietly one of the most successful financial policy interventions in history. Fact 45. The Glass-Steagall Act of 1933 erected a firm wall between commercial banking, taking deposits and making loans, and investment banking, underwriting securities and trading in markets. Banks holding ordinary depositors' savings could not gamble those savings in the stock market. The great financial houses were forced to choose what kind of bank to be. J.P. Morgan and Company chose commercial banking. Its investment operations were spun off to become Morgan Stanley. This wall would stand for 66 years, until its repeal in 1999, a decision whose consequences we will return to before our story is done. Fact 46. In 1933, Roosevelt took the United States off the domestic gold standard, requiring citizens to exchange their gold for paper currency at a fixed rate. Private ownership of gold above a small personal amount became illegal. The measure gave the Federal Reserve freedom to expand the money supply without being constrained by its gold reserves. More money in circulation meant more spending, more activity, more jobs. The economy began a slow recovery almost immediately. It was a radical departure from a century of monetary orthodoxy, and the moment the ancient anchor between money and precious metal first began, slowly, to be lifted. Fact 47. The Securities Exchange Act of 1934 created the Securities and Exchange Commission, the SEC, as the federal agency responsible for regulating financial markets. Before the SEC, markets had operated with almost no federal oversight. Companies issued shares with minimal disclosure. Insiders traded on private information. Manipulation was widespread and largely unpunished. The SEC changed all of that, establishing disclosure requirements and prohibiting fraudulent practices. Every public company in America today operates under rules tracing directly to that 1934 Act. There is something both humbling and strangely reassuring about this chapter. Humbling, because the suffering of the Great Depression was real and enormous, millions of lives diminished by forces the most powerful financial minds had failed to foresee. And reassuring, because the response produced institutions that have endured. Deposit insurance. Market regulation. The separation of risk from ordinary savings. Hard-won lessons of catastrophe, translated into law, so that the next generation might be spared. History does not always work that way. Let the 1930s settle into the past where they belong. The story continues, and the world it leads to is one you know. Segment 7. Rebuilding the World, Bretton Woods, the Consumer Age, and the Rise of the Everyday Investor. By the end of the 1930s, the New Deal had steadied the American economy. The banks were stable. The markets were regulated. And then the world went to war again. The Second World War consumed resources on a scale that dwarfed even the First. The United States, whose industrial capacity was untouched by the fighting that ravaged Europe and Asia, emerged as the overwhelmingly dominant economic power on Earth. More than half of the world's industrial output in 1945 came from American factories. The dollar was strong. American gold reserves were vast. Into this imbalance, a group of remarkable people gathered, not to celebrate victory, which had not yet been achieved, but to design the financial architecture of the world that victory would create. Fact 48. In July 1944, representatives of 44 Allied nations gathered at Bretton Woods, New Hampshire, for a 3-week conference producing the most consequential international financial agreement of the 20th century. The Bretton Woods Agreement pegged participating nations' currencies to the US dollar at fixed exchange rates, and the dollar itself to gold at $35 per ounce. The American dollar became, formally, the world's reserve currency, in which international trade was priced, debt settled, and central bank reserves held. Fact 49. Bretton Woods also created 2 institutions that would shape global economic life for decades. The International Monetary Fund, the IMF, was designed to provide short-term financial assistance to countries experiencing currency crises, acting as a lender of last resort for entire nations. The World Bank was created to provide longer-term financing for reconstruction and development. Together, they represented something genuinely new, a formal, multilateral commitment by the world's governments to manage the global economy cooperatively, rather than letting every nation fight for itself. As the post-war world was rebuilt, something remarkable was happening inside the United States that would transform the very culture of money. Fact 50. The post-war boom produced the largest expansion of middle-class prosperity in recorded history. Returning veterans bought suburban homes, filled them with appliances, and put cars in the driveway, purchased increasingly on credit. The modern consumer credit industry was born. Installment plans became standard. And in 1950, a man named Frank McNamara, who had forgotten his wallet at a business dinner, founded the Diners Club, issuing cards that allowed members to charge meals at participating restaurants and pay a single monthly bill. It was the world's first general-purpose charge card, the direct ancestor of the credit card in your wallet today. Fact 51. Bank of America launched the first true modern credit card, the Bank AmeriCard, in 1958, by mailing 60,000 unsolicited cards to residents of Fresno, California, in an experiment called the Fresno Drop. It allowed cardholders to carry a revolving balance and pay interest on unpaid amounts, the structure defining the modern credit card. The Bank AmeriCard eventually became Visa. MasterCard followed a similar path. Today the 2 networks process trillions of dollars annually. The global consumer economy runs, in no small part, on the infrastructure built by those 60,000 cards dropped into Fresno mailboxes. Fact 52. As Americans discovered consumer credit, a quiet revolution was also changing how they invested. Mutual funds, pooling money from many investors to purchase diversified portfolios, had existed since the Massachusetts Investors' Trust in 1924, but it was in the post-war decades they entered the mainstream. By putting a modest sum into a single fund, an investor gained exposure to dozens of companies. You no longer needed to be wealthy to spread your risk. You could buy one fund. Fact 53. The mathematical foundation for this diversification was laid in 1952, when a 25-year-old doctoral student named Harry Markowitz published Portfolio Selection in the Journal of Finance. He demonstrated that an investor's goal should be to construct a portfolio in which holdings are balanced against each other, so when some fall, others may rise, reducing overall volatility. This became modern portfolio theory and earned Markowitz the Nobel Prize in Economics in 1990. Almost every investment strategy used by pension funds and wealth managers today rests on the insight that young graduate student put on paper in 1952. The 1950s and 1960s were decades of remarkable stability. The Bretton Woods system was functioning, economies were growing, and the stock market was rising steadily. But like most benign environments, it bred complacency about the tensions quietly building underneath. Fact 54. By the late 1960s, Bretton Woods was under severe strain. The United States had spent heavily on both the Vietnam War and domestic programs, financing much of it by printing dollars. As more dollars circulated, other countries began to worry that America no longer had enough gold to honor its commitment to exchange dollars at $35 per ounce. France began demanding gold in return for dollars. The drain on American reserves accelerated. On August 15, 1971, President Nixon announced the United States would no longer exchange dollars for gold at any fixed price. The Bretton Woods system was over. The dollar, and virtually every major currency on earth, became what economists call a fiat currency, backed not by gold or any physical commodity, but purely by government authority and the trust of those who used it. Fact 55. The end of the gold standard, the Nixon shock, ushered in floating exchange rates, where currency values are determined not by government decree but by continuous market trading across every time zone on Earth. The foreign exchange market, known as Forex, is today the largest financial market in the world, with an estimated $6 to $7 trillion changing hands every single day. More money flows through currency markets in a single afternoon than the annual GDP of most countries. Money, in the modern era, floats free. We began with a farmer trading wheat for pottery, transactions grounded in things you could hold and taste. Real things. Tangible things. And we have arrived at a world where the most powerful currency on earth is backed by nothing more than belief. The gold is gone from the vault. What remains is faith, and the long, still unfinished story of whether that faith is enough. What remains is the world you recognize. And that is where we are headed next. Segment 8, Greed, Genius, and the Age of Deregulation. The 1970s were not kind to the American economy. The Nixon shock had untethered money from gold, and the decade that followed was among the most turbulent in modern American history. The Arab oil embargo of 1973 triggered a new and deeply uncomfortable phenomenon, inflation and stagnation occurring simultaneously. They called it stagflation, and the textbooks offered no reliable cure. By decade's end, inflation was running at nearly 13%. The Federal Reserve raised interest rates to nearly 20%, trying to squeeze it out, choking off borrowing, strangling growth, and making the late 1970s feel like financial purgatory. And then everything changed again. Fact 56. The defining financial philosophy of the 1980s, under Reagan in America and Thatcher in Britain, was deregulation, the deliberate rolling back of government rules on financial markets. The argument was elegant. Markets, left to themselves, allocate capital more efficiently than governments. Remove the restrictions, and prosperity follows. In practice, it led to loosened rules on savings and loan institutions, the thrifts holding mortgage savings of millions of ordinary Americans, allowing them to make riskier investments than ever before. Within a decade, this produced one of the costliest disasters in American history, requiring a government bailout of an estimated $130 billion. Deregulation, like all powerful medicines, came with side effects. But the 1980s were also a decade of genuine financial creativity, some reckless, some brilliant, often both at once. At its center was an instrument about to transform corporate America. The junk bond. Fact 57. A bond is essentially a loan. A borrower promises to pay regular interest and return principal at maturity. Bonds from weak companies pay higher interest to attract buyers and had long been called, disparagingly, junk bonds. Then a young analyst at Drexel Burnham Lambert named Michael Milken noticed something in the data: the extra interest paid by junk bonds more than compensated for their higher default rate. On a portfolio basis, they had actually outperformed investment-grade bonds over time. Milken became their most passionate champion, unlocking vast new financing for companies too small or risky for conventional markets. Junk bonds fueled an explosion of mergers and leveraged buyouts that reshaped entire industries. Milken became extraordinarily wealthy, and eventually the subject of one of the largest securities fraud investigations in history, pleading guilty to multiple felonies and serving federal prison time. The instrument survived him. Fact 58. A leveraged buyout acquires a company using a very large proportion of borrowed money, often 80 to 95% debt, with the acquired company's own assets as collateral. Private equity firms would take public companies private, restructure aggressively, and sell at a profit. The largest LBO of the era was the 1988 acquisition of RJR Nabisco by Kohlberg Kravis Roberts for approximately $25 billion, a battle so ferocious, so driven by ego and borrowed money, that it was immortalized in Barbarians at the Gate. It captured something essential about the decade, the sense that almost any acquisition, at almost any price, could be financed if you were bold enough to ask. Fact 59. The hedge fund had quieter origins. Alfred Winslow Jones, a sociologist turned investor, created the first hedge fund in 1949 by combining stocks he expected to rise with short positions in stocks he expected to fall, constructing a portfolio partially insulated from overall market direction. He also charged investors a performance fee of 20% of profits, aligning his interests with theirs. By the 1980s and 1990s, hedge funds had evolved far beyond Jones's original design, employing increasingly complex strategies. But the essential structure, pooled private capital, significant manager discretion, performance-based fees, remains the industry's defining characteristic today. Fact 60. George Soros is best known for a single trade in September 1992 that earned his quantum fund approximately $1 billion and branded him forever as the man who broke the Bank of England. Britain's pound was pegged within the European exchange rate mechanism at a rate Soros believed was unsustainably high. He sold short an estimated $10 billion worth of pounds, betting Britain would be forced to devalue. The British government raised interest rates desperately before conceding defeat on September 16, known ever since as Black Wednesday. The pound fell sharply. Soros collected his profit. It remains one of the most audacious macro trades in the history of financial markets. Fact 61. The computer arrived on Wall Street. The Nasdaq, founded in 1971 as the world's first fully electronic stock exchange, allowed buyers and sellers to trade through computer networks rather than face-to-face on a trading floor. Initially treated as a curiosity, it became the primary home of America's technology industry, the exchange on which Apple, Microsoft, Amazon, and Google would list their shares. Replacing humans with computers in the matching of buy and sell orders was the quiet first step toward a financial world transformed beyond recognition by technology. Fact 62. Program trading, computers automatically executing large numbers of trades based on preset mathematical criteria, played a central and controversial role in the most frightening single day in American financial history since 1929. On October 19, 1987, Black Monday, the Dow Jones fell 22.5% in a single session. For context, the worst single day of the 1929 crash saw a decline of about 12%. The 1987 crash was faster, steeper, and almost entirely driven by automated selling, program trading systems triggering each other in a cascade that overwhelmed the market's ability to absorb it. Fact 63. In the aftermath of Black Monday, the New York Stock Exchange introduced circuit breakers, rules automatically halting trading when prices fall beyond a certain threshold, giving markets time to breathe and human judgment time to reassert itself. Circuit breakers were triggered most dramatically during March 2020, when COVID-19 panic and cascading algorithmic selling caused 4 halts in 2 weeks. They are the modern financial system's acknowledgement that the machines it has built occasionally need a human hand on the emergency brake. The 1980s were a decade of extremes. Junk bonds financed real companies and fueled real growth, and also hollow acquisitions built on towers of debt. Deregulation unlocked dynamism and produced catastrophe. Computers made markets faster and more accessible and introduced instabilities nobody fully anticipated. The financial world, as it always has, was running ahead of its own wisdom. And somewhere, in universities and on trading floors, the next revolution was already quietly assembling itself. Rest easy. We are nearly at the world you know by heart. Segment 9, the Internet, the Bubble, and the Crash that changed everything. There is a particular quality to the optimism of the 1990s that is difficult to fully convey now, from the other side of everything that followed. The Cold War was over. The Berlin Wall had fallen. Unemployment fell to its lowest levels in a generation. The federal budget tipped into surplus. And threading through all of it, changing everything it touched, was the Internet. Here was a network with no geographic limits that could theoretically allow any company to reach any customer anywhere at almost no cost. The rules of business seemed to be rewriting themselves in real time. And investors reached a conclusion that was understandable, intoxicating, and ultimately disastrous. They concluded the old rules of valuation no longer applied. Fact 64. The dot-com bubble was one of the most spectacular manias in financial history. Shares of Internet companies were bid to valuations bearing no relationship to revenues, profits, or coherent business plans. Companies with names ending in .com raised tens of millions in public offerings having never turned a profit. The Nasdaq rose from roughly 1,000 points in 1995 to over 5,000 in March 2000, then fell 78% over the following 2.5 years. Trillions in market value evaporated. Hundreds of companies ceased to exist. The crash delivered a thunderclap reminder that new technology does not repeal financial gravity. Eventually, a company must earn more than it spends. Fact 65. From the wreckage, something durable emerged. Online brokerages transformed the accessibility of investing in the 1990s. Before them, placing a stock trade might cost $50 to $100 in broker commissions. Online platforms slashed those to $10, then $5. In 2019, major brokerages eliminated commissions entirely, making it possible for anyone with a smartphone to buy shares in virtually any public company at zero cost. The distance between ordinary people and financial markets had been reduced to essentially nothing. As the economy found its footing in the early 2000s, a different financial crisis was quietly building, in the housing market. Fact 66. A mortgage-backed security bundles individual home loans and sells shares to investors. Banks could move loans off their balance sheets, freeing capital for new lending. Investors received steady income from homeowners' monthly payments. The logic was sensible. But in the early 2000s, production of mortgage-backed securities accelerated dramatically, and the demand for mortgages to feed into them became almost insatiable. Which created a perverse incentive. If banks were selling mortgages immediately to Wall Street rather than holding them for 30 years, why be careful about whether borrowers could actually repay? They weren't. Fact 67. The subprime mortgage crisis had its roots in years of reckless lending. Lenders offered adjustable-rate mortgages with low introductory rates that reset sharply after 2 or 3 years. Mortgages requiring no income documentation. No down payment. In some cases, loans larger than the homes securing them. The assumption holding it all together, that house prices would rise indefinitely, proved catastrophically wrong. When it failed, everything built upon it collapsed simultaneously. Fact 68. Wall Street firms repackaged mortgage-backed securities into collateralized debt obligations, CDOs, then created CDOs made of other CDOs, building structures so layered that even their designers couldn't fully trace the embedded risks. Credit rating agencies assigned top ratings based on models assuming house prices had never fallen nationwide simultaneously and never would. When they did, the models failed, the ratings proved worthless, and the securities collapsed with stunning speed. Fact 69. Lehman Brothers, founded in 1850 and one of the oldest names in American finance, filed for bankruptcy on September 15, 2008, involving over $600 billion in assets. The shock was unlike anything since 1929. Banks stopped lending to each other. Credit markets seized. Within months, the global economy entered its deepest recession since the Great Depression. Fact 70. The Troubled Asset Relief Program, TARP, authorized the federal government to spend up to $700 billion purchasing toxic assets from struggling financial institutions. At its core, it prevented the collapse of the American banking system. These institutions had become what the memorable and uncomfortable phrase of 2008 described as too big to fail, so interconnected with the broader economy that the government had no practical choice but to rescue them, regardless of how reckless their behavior had been. Fact 71. The Dodd-Frank Act of 2010 was the most comprehensive overhaul of American financial regulation since the New Deal. It created new oversight bodies, established the Consumer Financial Protection Bureau, required complex derivatives to trade through central clearinghouses, and forced the largest banks to hold more capital as a cushion against losses. Whether it went far enough, or too far, remains contested. But it marked a clear acknowledgement that the system producing 2008 could not simply be restored and trusted to behave differently. Fact 72. The Federal Reserve responded with actions unprecedented in its history, cutting benchmark interest rates to essentially zero, then embarking on quantitative easing, purchasing trillions in government bonds and mortgage-backed securities with electronically created money. Between 2008 and 2014, the Fed's balance sheet expanded from roughly $900 billion to over $4 trillion. The reverberations, in asset prices, in inequality, in housing costs, are still being felt by ordinary families today. The 2008 crisis was not a natural disaster. It was built, piece by piece, by decisions individual human beings made, about what to lend, package, rate, buy, and trust without fully understanding. The people who made those decisions were not simple villains. They were responding to incentives the financial system itself had created, rewarding short-term gain and insulating decision-makers from long-term consequences. That is the oldest story in finance. Older than mortgage-backed securities, older than junk bonds, older than the South Sea bubble. The gap between what an instrument can do and what the people wielding it will choose to do. That gap has never fully closed. But in every generation, it has produced people determined to narrow it. Rest gently. There is one chapter still to come, and it is the chapter in which you, right now, are living. Segment 10, The World You Know, Bitcoin, Algorithms, and the Future of Money. We have traveled a very long way together. From a farmer in ancient Mesopotamia with too much wheat. Through the temples of Greece and counting houses of Florence. Past the coffee houses of London, the railroad barons of the American frontier, the locked library of J.P. Morgan, the burning wreckage of 1929. Through Bretton Woods, junk bonds, the dot-com euphoria, and the slow-motion catastrophe of 2008. And now, finally, gently, we arrive at the present. Fact 73. While regulators were still working through the wreckage of 2008, someone under the pseudonym Satoshi Nakamoto published a 9-page paper proposing an entirely new kind of money. Bitcoin would be a purely digital currency with no central authority, maintained instead by a decentralized network of computers recording every transaction on a shared public ledger called the blockchain, tamper-resistant and extraordinarily difficult to falsify. Nakamoto has never been identified. The inventor of a currency worth hundreds of billions remains one of the great unsolved mysteries of the financial world. Bitcoin raised the oldest question in money: is it only what governments say it is, or can trust among ordinary people create something just as real without a central bank's guarantee? Fact 74. A quieter revolution was already underway in investment management. The index fund, simply buying every stock in a market index in proportion to its size, had been pioneered by John Bogle of Vanguard in 1976. Wall Street dismissed it as unambitious. Decades of evidence proved the critics wrong. The overwhelming majority of actively managed funds failed to outperform their benchmark index after fees. By the time Bogle died in 2019, index funds managed more money than any other structure in investing history and now hold more than half of all assets in the U.S. stock market, one of the most consequential transfers of wealth from financial professionals to ordinary investors ever achieved. Fact 75. The rise of fintech produced companies attacking every corner of traditional banking. Payment apps made transferring money as simple as a text. Robinhood eliminated trading commissions, pressuring the entire industry to follow. Digital lenders underwrote loans using algorithms. Neobanks offered full accounts through smartphone apps. The smartphone turned out to be the most powerful financial instrument ever placed in ordinary people's pockets. Fact 76. High-frequency trading, executing millions of trades in fractions of a second, accounts for a significant portion of all trading on American exchanges. Firms position servers as close to exchange engines as physically possible, because advantages measured in microseconds make the speed of light itself a competitive constraint. The financial arms race for speed now operates at a scale entirely imperceptible to human senses. Fact 77. ESG investing, weighing environmental, social, and governance factors alongside financial returns, grew from a niche idea into one of the dominant conversations in global finance. Formalized in a 2004 United Nations report, it argued that a company's environmental practices and governance were not just ethical considerations but financially material ones. By the early 2020s, trillions were managed under ESG frameworks, and the debate over whether ESG labels reflect substance or marketing shows no sign of cooling. Fact 78. The COVID-19 pandemic produced extraordinary financial events compressed into weeks. The Dow Jones lost 37% in just 34 days. The Fed cut rates to zero and launched unlimited quantitative easing. The government injected over $2 trillion into the economy. Then the market stunned observers by recovering almost completely within 5 months, reaching new highs by August 2020. Even as the pandemic raged. The disconnect between markets and lived economic reality sharpened, for many, the question of who the financial system ultimately serves. Fact 79. In January 2021, retail investors on Reddit's r/Wall Street Bets coordinated to buy shares in GameStop, a struggling retailer heavily shorted by hedge funds. Their buying forced short sellers to cover positions, briefly carrying the stock from $4 to nearly $500. Several hedge funds suffered billion-dollar losses. For a few days, small investors had beaten some of Wall Street's most sophisticated players. The episode illuminated both the democratizing power of commission-free trading and the enduring truth that momentum-driven markets can reverse just as quickly as they rise. Fact 80. Artificial intelligence is now embedded in virtually every layer of finance, approving loans in seconds, flagging fraud before you notice it, executing millions of trades without human involvement. The full consequences for employment, credit fairness, and market stability as AI systems increasingly trade with and against each other are questions no one can yet fully answer. Fact 81. Despite every crash and crisis, the long-run return of the global stock market has been remarkably consistent. An investor who placed money in a broad index in 1900 and never sold, through 1929, the Depression, 2 world wars, stagflation, the dot-com bust, 2008, and 2020, would have seen growth of approximately 9 to 10% per year. Every catastrophe that felt like the end of something proved to be a chapter in the middle of a much longer story. From the wheat fields of ancient Mesopotamia to blockchain servers humming in data centers you will never see. From cowrie shells to cryptocurrencies secured by mathematics the ancient world could never have imagined. What has remained constant across every century is simpler than any financial instrument ever devised. Trust. The willingness of one human being to accept something from another, a shell, a coin, a piece of paper, a number on a screen, and believe it holds value. Money is not gold. It is not paper. It is not code. It is a story that billions of people agree to tell together, about worth, and work, and what we owe each other. That story began around a fire, a very long time ago. It is still being written. You have been part of it all along. Sleep well. You have earned it.